All right, Monday market update. Are we finally seeing stability in mortgage interest rates? Is Jerome Powell going to be fired? This and so much more as we go over the happenings in mortgage-backed securities and the real estate market. A little color commentary from myself. I'm joined by Nash Paradise, Director of Sales, the Lone Wizard. On this beautiful Monday morning, I'm Matt Gouget, affectionately known as Matt the Mortgage Guy, and we like to bring you, from the trenches, reporting and updates from the field, if you will. A couple of guys who write, quite a few mortgages. We're around a bunch of folks at U Mortgages writing quite a few mortgages as well. So I tend to think we know a thing or two about mortgages and real estate. How you doing, Nash?
Doing good, man. It's a beautiful Monday here. Found out my kids are off school today. That was kind of a last minute surprise. So here at the unpainted home office, kicking it. But we're gonna do some fun family stuff today. Maybe go play some golf this afternoon, because to answer your hypothetical question, are mortgage rates going to get some stability? We don't know. And like you said, we know a whole lot about lending. Guess what we don't know a whole about? Politics,
Right.
tweeting, where are things going? You can know a whole lot. And right now, we all look kind of stupid because hindsight is the only 2020 vision right now. But that's what we're here for, is to talk about what's been going on, maybe a little bit about what's going to go on, and try to be best prepared so we can tackle this market head on. So if it's cool with you, let's jump right in the news, check out where we are on the slides, and see what happened last week. And I know, you weren't here last week. I was talking with my buddy Tyler, and economic news has been significant. It's mattered, except it doesn't matter, because economic news is nothing compared to a tweet, which is where we are right now. It's probably going to put me out of a job. But, retail sales up, building permits missed a little bit. Initial jobless claims, pretty close. Okay. None of these things were really impactful anyway. We had a shortened week with Good Friday, but what happened to interest rates? They got a little better, then they got a little worse. So did the economic data have anything to do with it? A whole lot of no. You got China selling bonds. You've got, the US talking about the treasuries. You've got the president tweeting about the Fed. That moved the markets, not econ news. So is it even worth talking about the econ news? Maybe, but last week it's actually kind of boring. So I'm going to say let's look at actually what's coming. Let's see if we have anything more interesting coming up in econ news this week. Maybe we can have something to circle, something to get excited about. Nope. A lot of the same. It's rare that we have a couple of weeks in a row where there's just nothing real good that's coming out. Normally we'd be really excited about S&P Global Manufacturing PMI. Like Wednesday should be a good day, should be an interesting day to see things move. But lately, and even with the consensus and the forecast where they've been on inflation, everything that we're worried about is going to take longer to come to fruition. All the tariff stuff, all the increased costs, but like, hey, gas is down, but look at the cost of gold. Like things are moving around at pretty rapid levels right now. There's a lot of instability, but they're not going to impact, S&P Global Services PMI that fast. Is there anything that pops out to you where you're like, oh, hey, cool, neat, this is coming?
Not necessarily, but I'd love to get your take too. And in case people missed it, what Nash is saying is a lot of these economic data points were things that in the past we could point to and say, based on, how this number comes in, we're going to see an impact on mortgage interest rates. In our current environment, the volatility and the movement in mortgage-backed securities has more to do with things that are going on politically. Does that sum it up pretty much, Nash?
Yeah, 100%.
So,
Prior
so
to
I guess
like this
my
week,
question, or I'd love to hear your take on this. When does that change, or does it? Right? Are we going to get to a point where some of this economic data will again have the influence it once did, or we just live in a new era where political changes have taken over? They now hold the levers to mortgage-backed securities and what happens with our mortgage rates.
That's a good question. I think the answer to that question is who actually moves the markets. And, not the Fed, it's not even the president, it's not tweets, it's billion-dollar market movers. It's China selling off billions of dollars in treasury bonds. It's money, it's the big money. So big money used to react to economic data. You come up short on a jobs report, there's money to be made there. There's going to be sells, there's going to be buys. There's going to be people that are bullish. There's people that are going to have a bear opinion on the market. They're going to be moving money around. Their job is to make money. There's too many conglomerates that have too many tens of billions of dollars that can put in and out of the market that are going to drive things, and they respond usually in advance of the econ data, which, feels a little funny to us normal people. I'm like, well, how did y'all know this was coming? But all that said, that's the way things used to be. Now, at least for the next few years, we have an administration that is very vocal about things related to expenses, about inflation. Inflation's become a hot topic. I remember 10, 15 years ago, like something you talked about, but it wasn't like an everyday occurrence. Affordability is not getting better. Inflation may be going down, but it's still coming on top of years and years and years of some of the fastest inflation we've ever seen. So as long as the average American cares more about the cost of gas and eggs and these things have become politically charged, that's where the focus is going to be. And that's where pundits and politicians are going to be discussing these things. And then the money is going to be chasing after that. So I think for the interim and for a while now, we're going to be paying more attention to, what the global political climate looks like as we come out of this post-COVID mini recession or whatever we're in right now. I don't know that we're getting back to normalcy anytime in the next 3, 5, 7 years.
Yeah, could be true. Could be true. All right, man. What else we got as far as news? Anything that stands out to you that we should be looking out for?
Not this week. I mean, initial jobless claims will be interesting. The job numbers have been pretty consistent for the last few weeks, and even when they did miss slightly, it didn't really move the needle on anything. So what I'm interested in is with the president talking about the Fed rate decisions and needing to cut rates. What we saw last week when we were going through the projections on the dot plots was actually kind of a pullback from, 2 weeks ago. It looked like 4 cuts were all but certain. Now with tariffs potentially impacting inflation numbers, it was down to about 3.5 or so. So I'd love to jump forward here and take a look at what we're seeing with the Fed funds rate futures, and just to kind of clarify what this looks like for anyone who hadn't seen this chart every week with us. The blue is, basically the consensus. That is where most of the Fed governors believe things are going to be. So right now we're in that 425 to 450 mark there in the top right. We have stayed consistent with the first drop by June, but it has come down a lot. If you'll remember a couple weeks ago when we were talking about it, it was like 90-something% showing a rate drop by June. Now we've got some holdouts with no rate drop by then. By July, we're all but certain. So like by July, we're going to have at least 1 rate drop, but now July looks more like 2. A third most likely by October, and then a 4th rate drop is getting iffy right now. The 4th rate drop certainty based on the governor poll is January of 26, but you'll remember that 12-10 meeting used to look like a lot more than that 67% threshold for having a 4th rate drop. And I think getting into looking at the dates on these, it's kind of interesting to think that having a drop June and then July, I don't know that that's necessarily going to be a great thing when we tend to drop early and drop quickly like that back to back, because the impact doesn't usually have an instant reaction. Mortgage rates don't seem to like that. You remember the last couple, mortgage rates actually went up in the initial wake of that Fed funds move.
Yeah, we had some hard conversations to be had when people were like, "Oh, hey, I heard mortgage rates got cut." Like, no, the Fed cut the Fed funds rate, and mortgage rates went up 0.25%. So be careful what you listen to. But yeah, interesting stuff. And to reiterate something you said earlier, and maybe this was even before we jumped on. Jerome Powell, a lot of pressure from the current administration to cut the Fed funds rate, and I don't think that he's necessarily listening. I think he's continuing to do what he does at the Fed, and like him or hate him, the guy looks at data and tries to make a best decision for the economy as a whole, based on the data. And to your point, keeping an eye on inflation and unemployment and those things. He's going to do what he thinks is right, regardless of what others are telling him he should or shouldn't be doing.
Yeah, he feels very insulated. The Fed was designed to watch over monetary policy for the U.S. and to be completely separate from any kind of, political influence. Like, as the design, part of that makes sense. You don't want politics to be able to overly influence the Fed. The Fed is supposed to keep us stable. It's supposed to grow the economy at a certain rate, and it's supposed to protect jobs. That's the job. When you drop the Fed funds rate, you eventually make lending cheaper. And we're talking short-term loans. Credit cards will start to follow that, home equity lines, auto loans, things of that nature. As things get less expensive, people tend to spend more. As people spend more, the cost of things go up. So yeah, if inflation is still a problem right now, keeping interest rates high, reducing and curbing spending should help bring the cost of things down. That's where we've been. That's what we've been looking forward to. In fact, this chart looks a lot like what we expected to see last year, but this is definitely, hashtag higher for longer. Things just haven't moved that quickly because consumer access to credit has been so high. Home equity lines, being able to sell a house, buy another, cash out. Credit card debt has been going up. People are still spending at the same levels. They're just going in debt to do so. So it's taking longer. Consumer behavior has adjusted a lot since COVID, and it makes it a lot more difficult to predict the future on how spending and things are going to be impacted by the Fed funds decisions. That said, I think we are finally in that spot, but with the changes in the consumer confidence lately and everything just related to the tariff back and forth, that will cause things to be a little bit more expensive. And if it's more expensive, then they're going to want to keep rates a little bit higher for longer. And Powell's been clear about that. We'll see if the president has enough influence and power to try to fire him. I doubt they're going to do I know they're not going to do what he wants them to do. Powell is a nerd and very straightforward, and he just said no. Like, he's not. He was appointed by Donald Trump in his first presidency, so he was Trump's dude, but he's also fairly apolitical. So if he believes that and the rest of the Fed governors and chiefs all believe that things need to stay higher for a bit and they need to be, slow in the roll on the drop, that's exactly what's going to happen. And unrelated to the Fed funds, let's take a look at what everyone is really here for, and that's mortgage rates. It's what we care about. I love that you decided to take off on the week that I had to come in here and talk about that gigantic increase from about 6.6 to 7.1%. And then somehow you decide to come back when things are getting better. So I'm going to make you go ahead and talk about what's been going on here in the last 2 weeks since you bailed out on the bad news.
I always come back for the good news to share the good news. And for anybody who was paying attention, we had been relatively stable at, call it, 6.75%, and saw a pretty dramatic bump up in mortgage interest rates where we got back above 7. Last week was our get back week, our what do they call it? Where where we get a little bit of a bounce back from those losses. And so, they've gone back down somewhere in the middle, somewhere in the 6.875 range. And, really, I think it's not the specific rate that is something that people are afraid of. It's the volatility. And a lot of people in the market, when there's volatility, I think it causes inaction. And so I'm in a lot of investor groups who tend to think it's the year of the investor, because as more inventory comes on and the average, home buyer presses pause for one reason or another, right? A lot of it's uncertainty, and uncertainty causes them to not take action. Investors come in and they find great deals, stuff that's been on the market for 60 or 90 days that hasn't sold. So it'll be interesting to see. We're in what is the beginnings of the busiest time of the year for home sales. So it's gonna be interesting to see what, all this uncertainty in a few different areas, right? In tariffs and the political climate, uncertainty in mortgage interest rates and whether they're going up, down, or sideways. And so it's I think that we're going to have some things to talk about in these next coming months. We got a couple weeks until that next Fed meeting, but I think it's for me, Nash, the conversations I'm having, uncertainty seems to be something that is more prevalent than I've seen in other periods of my mortgage lending career. What about you? What kind of conversations you having with people on the streets?
Yeah, I mean that ties me right into my final thoughts on this. This is the great pause of 2025. Like you said, we would typically be seeing the start of the spring buying season right now. We're not. There is a lot of pent up action that's ready to hit the real estate market. There are lots of buyers sitting on the fence. There are lots of people that would like to sell and buy. There's just a bunch. It's a powder keg waiting to go right now, and it needs a spark. And that spark was completely doused a couple weeks ago. It started to look like we saw application volume across the board coming up big time. And then all of a sudden, just a big old pump the brakes. People wanted to make sure before they make a decision that they know what things are going to look like in 6 months, 9 months, 12 months. And I think the difference now than in the 19 years I've been doing this is because costs are at all-time high, because affordability is so high, because interest rates are so high. People are a lot less willing to just roll the dice. They're not saying, well, we'll see what happens politically, but hey, let's go buy this $220,000 home. That's 2,000 square feet and 5 bedrooms. No, it's a major life move when they're like, hey, do we sell our home and get out of this 3.5% rate and go take this one at a 6.875? Like, you're going to be very sure about yourself. So that lack of consumer confidence and stability definitely polished everything. The good news is they're not going away completely. They're just pumping the brakes. So I think as we get in the next couple of weeks and we start to see some resolution with the tariff stuff, we start to kind of see what that is like to live in it. And it starts to move past the most interesting news cycle, especially if we get rates to settle down just a little bit. This 6.87 mark is not ideal. It puts your government loans, FHA, VA, USDA, up in like the low to mid sixes. It puts conventionals up in the upper sixes. We do a lot better, and people get a lot more excited when conventional is mid sixes and when the Govy stuff is in the high fives. We were just there for a few days. So I believe that we are right on the precipice of being real busy and seeing the market take a nice turn. And, thankfully, as mortgage professionals, we know what's coming and we know what to look for. But that's my call to action today, is to talk with those buyers, talk with those real estate professionals, and make sure they understand that this is what's coming. This is what the market is looking like and is ready for. And, just be as well prepared as you can.
Yeah, agree. Yeah, we'll watch rates because they have an effect on demand, no doubt, right? Rates come down 0.5%. You see a lot of those people that are, like you said, sidelined, spring into action. So we'll be back next week to talk more about it. As always, man, I appreciate your insight and chatting with you, brother. Have yourself a phenomenal day today with the kiddos off school, and talk to you next week.
Awesome. Take care, homie.
Later, brother.